Our first homework problem is the Dakota Corporation. This is problem number 1. It's exercise 19 in your text. And they give us a bunch of transactions and they ask us to lay them out in the accounting equation. So if you printed out the template, you have this, and we'll just go through and we'll label each item. So they issued stock. In other words, they sold stock, they got cash. So that's $30,000 in cash and $30,000 in common stock. Remember, we have to put it on both sides so that both sides balance. Then they purchased some land, and remember, land is an asset, it's something of value. So our cash went down $12,000, but our asset land went up $12,000. None of the other accounts were affected. The next transaction they told us is that we borrowed $10,000 and we signed a note payable. So when we borrowed, our cash went up. Now, assuming we went in to borrow the money with a cash and not a mask and a gun, we're going to pay it back. So we also have a note payable. And a note payable is simply a contract that says you're going to have to pay this back, and you've signed it and dated it and agreed to it. The next transaction, they tell us, is that we provided $20,000 worth of services. So we got cash of $20,000, and $20,000 of services goes to net income, and net income goes to retained earnings. Remember, revenue minus expense equals net income. And this falls into a funnel that comes right down to retained earnings, which is part of common stock, which is part of liabilities, which equals assets. And that's new and confusing and different for you right now, but we're going to get to that. That's the expanded accounting equation. But for right now, what you need to know is that that revenue increases the value of the company, and for now we're storing that in retained earnings. The next transaction, they paid our light bill. I don't know what we did to use $100,000 worth of liabilities, of utilities, but we did. So when we paid it, our cash went down. There's no doubt in your mind about that. I'm assuming you pay your bill, you have less cash. And therefore you have less cash, so you're worth less. So your retained earnings, the ownership of the company, goes down by $1,000. Then we paid other operating expenses, salaries, taxes, advertising, whatever. So our other operating expenses were a total of $15,000. So again, our cash goes out, and we end up being worth $15,000 less. Then we paid dividends. And dividends are when you're giving some of the money back to the owners of the corporation. You're sharing it. You're divvying up the income. So you gave them $2,000. So your cash went out. And your company is now worth $2,000 less because you gave the money back to your owners. Now the last one is a little bit of a trick question because they want you to think you're supposed to do something. Well, there's an accounting rule that says whatever you buy, you keep at its historical cost. So our land went up in value, our land could have gone down in value, our land could have been turned into a thermonuclear wasteland. It doesn't matter. We do absolutely nothing. Okay, so that's taking the transactions that happened and we're writing them down and we're putting them in the equation. And if you add that all up, it should balance. Let's see that it does. I believe that totals to $32,000. More than I believe. I actually have a crib sheet here. I worked the homework. The land is $24,000. Now remember, there's equal signs all the way down here. No matter what happens, this side must equal this side. Gotta. Always. So let's add up that side. The notes payable, well, $10,000. I can do that one in my head without a crib sheet. Common stock, 30 and 6. I can do that one. $36,000. And the retained earnings is 8 plus 20 minus 1 minus 15 minus 2. That's 10,000. You add these together, it's 56,000. You add these together, it's 56,000. We're good. Our balance sheet balances. The next thing it asks us to do, part B, is to make an income statement. Now, an income statement sounds like it's some sort of really complex, difficult accounting sort of nonsense. It really isn't. It's revenue, what you got for doing what you do, minus expenses. That's what you had to spend to earn the revenue, gives net income. And I want you to see that whenever you see net income, I want you to automatically visualize this funnel coming down to retained earnings, because the owners of the company own the net income. Retained earnings plus common stock is the total equity, the total ownership of the company, plus liabilities, and that always has to equal the assets, the things we have. So the things we have are equal to what we owe plus what we own. So let's take a look here. We only had one service revenue, and that was $20,000. So we had service revenue, $20,000. We had utility expense of $1,000, and we had operating expenses of $15,000. Sorry, Woodstock flashback. $15,000. So 20, take away 16, our net income, $4,000. Congratulations, you just did your first income statement. That's our problem 1, part A and part B. Stay tuned for the next parts.